I think a lot of it is people understanding numbers for sure, understanding the deal, understanding the asset, understanding the structure, understanding the market, understanding the operator. All these things are all data points that add up at the end. So when we talk, we're not going through them, but these things are happening so quickly, so fast, and all at the same time that sometimes we don't break down that process in our mind, how we're going through. And if you go in with thinking that you're going to invest with somebody before you even do due diligence, you're going to skip all that.
All right, welcome to another episode of the Legacy Wealth Podcast. I'm your host, Pascal Wagner, and on this show, we teach accredited business owners how to invest in private alternative assets. And today on the show, we have Jay Bourgana, who is a veteran management consultant turned business owner. He started the Homearly Real Estate Group, which he grew from 0 to 350 million in real estate sales in 4 years, facilitating over 5,000 real estate transactions and subsequently getting acquired. And now Jay is the founder of Foresight Partners, a private equity company committed to turning good businesses into exceptional ones. He lives in Oahu, Hawaii with his wife and 2 kids, and he's invested over $2 million as an LP, and I'm super excited to have him on the show. Welcome, Jay.
Thank you for having me.
Hell yeah. So to get us started, as I love to start every show, give us a little bit of your background and story of how it relates to eventually investing in your first fund.
Yeah, so I had just sold my company, and I was kind of looking for ways to invest, and I started investing in real estate. I bought commercial retail centers, and I bought some short-term rental properties. And being part of multiple mastermind groups, started hearing about the high returns that some of my friends were getting through limited partnerships, and I got curious. So I started diving deeper into multifamily syndications as well as private equity funds, and that's when I started investing. Got it.
So give us a little bit more of the journey of before you started investing in these funds, of like maybe why you didn't start doing it earlier and how you just kept reinvesting in the current business that you had then before getting acquired.
Yeah, and I mean, when you're growing a business, especially the way we were growing 40% a year. You're constantly reinvesting back into hiring talent, marketing, operations. So honestly, there wasn't enough room to be able to invest in anything else outside of the business that I was growing. And like you mentioned earlier, we went from 0 to $350 million in sales within 4 years. It's massive growth that requires a lot of energy, time, and capital. And there was no room for that. It was either going to sell or I'm going to take on a partner and get a liquidity event to be able to have enough capital to be able to invest in anything else.
Why did you eventually end up selling? Like, why not continue growing that business, put someone in place, maybe be more passive? Why sell that and then invest your capital elsewhere?
That's a great question. So the goal for me was to essentially grow easier, faster. And we had essentially we wanted to connect to a mothership. So the company that bought equity in our business was a $6 billion company, and they were growing through acquisition fast. And so we had the ability to join them and absorb some of the divisions that look like ours and increase our revenue and our profitability without adding more overhead, and also just tag along to their organic growth. The company's been around for 40 years, so it almost has its own gravity pull. So they get people. It's a lot easier for them to recruit. It's a lot easier for them to get the big companies, big banks or big organizations to work with them. And so just having affiliation with them had opened up doors for us. So when we joined them, we essentially doubled every year from now on, from that point on. So I ended up exiting twice. I exited the first time and exited the second time at the end, 3 years later.
Got it. So you joined with this company. They took an equity stake. You continued growing with them, and then eventually they just bought the whole company.
Correct.
And
Correct.
you were, and it just was the right time to do that. And then that's when you moved on.
Yes, correct.
Okay. So then walk me through. So you have this big pile of cash, and it's probably burning a hole in your bank account. What are you doing then? Why not look at equities? Maybe you did. Maybe you've put a portion of it into all these different investments. How did you think about what to do with that pile of cash?
Yeah. So at first it was a tax mitigation strategy. So I needed as big of a commercial building I could get to cost segregate and get depreciation to alleviate some of that tax burden. So that was the first thing. And then the next thing was, okay, well, let's invest in something that's growing. So at first it was commercial real estate for taxes. And then we looked at short-term rentals as a way for fast growth and high cash flow, high revenue. But at the same time, the real estate values were growing up so fast. So we can build equity and we can pull that equity and reinvest back into other things. And then we went into real estate flipping was big. So I invested in as an LP in a syndication. And then I went into multifamily now because multifamily was doing so well at the time and the returns were really high. So I went, I'm talking the period between, 18, 19, I was doing stuff on my own. 20, 21, 22 is where everything was hot. And that's when I went more limited partner than doing stuff on my own.
Yeah. So when you talk about, you had this big tax burden from this acquisition, was your goal to try and reduce that tax down to zero? Was it to 50%? And then, so each multifamily deal that you might have invested in gave you, like, you invest $100K and you can write off 50% of that. What did that look like, and how did you think about that?
So at first it was always looking for dollar for dollar. So I wouldn't do any investment unless I put $1 in. I get $1 in depreciation. So that was usually my investment, my thesis, because I did transactions on my own where I got more. I got $2-3 per dollar invested in depreciation. So it's very important for me to get that maximize the amount of depreciation I get during that first period. And then once I did that, then the second thing was how can I maximize the cash flow? And then later on, when value appreciation was going up, then I was like, oh, how can I maximize the amount of like big exits? And then once the market turned, then we started focused more on cash flow than anything else because we knew valuations were going to go flat.
Totally. Okay. Helpful to frame that picture. So walk us through that first fund that you invested into. Like, who were you talking to? How'd you get introduced to it? How did you make the decision to finally overcome the fear of investing in your first deal?
Yeah, so I'm part of GoBundance, and I've been in GoBundance since 2017, and I've been to a lot of the events. I've been to a lot of chapter events, and at the time I lived in California, so I was close to the LA chapter, and we used to meet all the time, and so I used to hear all the outcomes, all the hey, we we just sold this multifamily building, and I'm getting double my money, and only after 4 years, and so and so did such a good job. I'm going to reinvest back into the same fund. So when you're surrounded with people that are smart and that have had multiple experiences with certain operators, it's much easier to just piggyback on that experience and say, hey, can I get the contact of so-and-so, and let me reach out to them and sign up for their website or whatever, and then have that one-on-one Zoom call with them, and then understand what the pipeline looks like for them in terms of the next couple deals. And that's how it worked for me. It was just being around people that have already invested in other funds and then just piggybacking on their experience.
Yeah, making it so that when you're surrounded by a bunch of people who've already done it, it makes it so much easier to take that next step.
Yeah, absolutely.
Yeah. So I wanted to go down the rabbit hole of one of those more of that first fund, but
yeah.
Do you think there's more to uncover there? Or?
Well, go ahead. What are your thoughts there?
Yeah, I mean, I'm interested in what did that first deal look like? Okay, so you're in this time period where you want to get a bunch of depreciation for your tax burden, and did you think about, I want to make sure, I don't care really what the deal looks like. This operator is one that my friends have invested into, and I'm super interested, or what did the diligence look like for that first deal?
Yeah, that's a good question. Honestly, the diligence was because at the time when I first started doing this, I didn't know enough. I didn't know what I didn't know. Now I've done a few deals, I understand more. But at the time, I wouldn't understand what an IRR was. I would tell you what I was thinking through. I was thinking in terms of capital multiples. So I heard that so-and-so got 2 times their money within 3 to 4 years. I want that. And then tell me about this deal. Tell me about your projections in terms of rent growth, your projections in terms of interest rate, your projections in terms of So I got that first deal analyzer. I looked at it. I asked the question about where they got their rent growth. And the person that I invested with the first time was very conservative, so it ended up doing much better than what was projected. And also the time, we're talking about 2019. So everything that you bought in 2019 did really well the following, 4 years. So honestly, I got lucky in a way where I had friends who have, so they gave me like 2 or 3 people. So it's kind of like a little bit of a psychology too, because they gave me 3 people to talk to. The first one didn't want to talk to me. He didn't want to take my money. He didn't want to take on new investors. He was like already had plenty of investors that are experienced, know him, trust him. And he almost like was reserving positions within his deals for these investors that he's worked with in the past.
Which I think is pretty common, actually.
Yes. Yeah. So now having that experience, I felt like awkward a little bit, or I felt like I'm not good enough. And so that was part of like, almost like as you're going into the next conversation, you're not trying to push too hard, or you're trying not to be hard to work with, or you're trying to, you know what I mean?
Right.
So that's where kind of like almost like a reverse psychology there, where I had to kind of get my due diligence was a lot weaker, but I understood what I was looking for. I was looking for a certain multiple on capital. I was looking for understanding of what the assumptions were in the deal. And for me, it's not really a matter of like accuracy of the information, is the tone on how their things are explained. It's more qualitative. I used to be a business consultant, and I interviewed thousands of people. So I've developed essentially pattern recognition for people. And so I can tell when someone is, telling you the truth, someone is bullshitting. I could tell someone is, someone is knows the details, understand the assumptions and where they're coming from, and they can explain any number within their spreadsheet. And I know the people that are copy pasting stuff or just using old spreadsheets or just BSing the numbers. So so I can rely on that pretty much to achieve probably 80% of the outcome.
Yeah. Is there like a type of tone that so, I mean, you're pretty much just saying if you're noticing that someone is a little squeamish or they're not as, on top of knowing the metrics or, parts of the deal, then that's a flag for you. Yeah.
Or sometimes they get defensive. Sometimes they get uncomfortable. Sometimes they get, why are you asking me these things? Like, give you that tone. Or sometimes I'm like, oh, let me get back to you on that. Or maybe there's contradictions in their stuff. People who do this at a high level are excited to explain their deal. You know what I mean? They're excited to tell you the story of the deal and how they found it and how they came up with the number and how they, if I do the deal, I'm excited to show, to walk through it. So, when I get that defensiveness, when I get that, people are, or like salesmanship, they're trying to they're trying to sell me on it. Sales techniques, NLP, all that good stuff. I've been there, done that. So it's just gonna take a lot longer for me to really be comfortable with the deal. And if I'm not comfortable, it's not worth my time.
Totally. Yeah. You have to feel good about who you're investing in and what you're investing in.
Yeah.
Now you've invested in a ton of different types of deals.
Yeah.
Everything from multifamily, commercial shopping centers, self-storage, ATM funds, short-term rental funds, or syndications, and even like a managed service provider fund.
Yeah.
Talk to us about, like, those are all very different. And I imagine you don't have expertise in most of them. How did you figure out that you wanted to invest in those asset classes? How did those opportunities come about? How did you think about that?
Having been a management consultant, I'm used to being dropped into different industries and different places and different geographies. So I'm comfortable with the change, or with the what's the word? Things being obscure, things not being transparent, things to being new. So for me, I can spend probably an hour talking to somebody and understand the drivers of that business. And I may actually reveal the drivers to the business owner who's running, and because they may not know, what the drivers are, because I've seen so many other businesses. This one looks like that one. So I'm comfortable with that aspect of it. I just want to understand the drivers of the asset. What are we trying to achieve? Are we going for steady cash flow? Are we looking for that big equity win? Are we going for a turnaround, or a value add, or some type of arbitrage of some sort? And so once I understand the strategy, I want to understand the asset. Once I understand the asset, I want to understand the market. Once I understand the market, I want to understand the operator. And so I think that's pretty much the process that I go through mentally. And then once I understand the operator, then I go through the numbers with them. By then, it's already kind of made my decision, but I just want to kind of reinforce what I just learned. And then once that happens, then it's easy for me to say yay or nay.
So you've talked about that you had two kind of different strategies. One was more tax depreciation as a benefit, and the other one was cash flow. Which investments had the highest tax depreciation, and maybe like what are the reasons for that?
Yeah, we have big retail, standalone retail, as well as shopping centers in the middle of the country kind of markets, like Minnesota. And so, because the value of the building is 80% of the value of the whole thing, you get the maximum amount of, and then also, assets, their cash flow, you can buy at a 7, 8, 9, 10, 11 cap. And at the time, and then you could finance at, 3%. So there's a big enough gap. And you get both. You get a little bit of cash. You get decent cash flow, and you get max depreciation.
Yeah, and I also know that, so for example, we're both in an ATM fund. I'm wondering if we're in the same one.
Yeah.
But because those.
Which one?
Oh man, I'm in
David Zook.
David Zook, Prestige Equity Group.
Yeah.
Yeah. So
the leverage. I'm in the leverage one. So that one also, that's a great one. I like that one a lot.
Yeah. And just to kind of like highlight the depreciation aspect, it's you're investing, at least in this fund, it's a fund that invests in 4,000 ATMs across the country. And we're talking like automated teller machine things where you go and you put in your credit card or your debit card and you get cash out. And because these are machines, you're pretty much able to write off most of your investment. I think it's like 90 to 100%. And then those things spit out cash flow. So whenever you get charged that $3 fee from using an ATM, that's what the revenue that the fund collects that we are then getting those monthly mailbox money checks. So so that one kind of spans both the depreciation and the cash flow, and kind of can achieve both of those goals. When you're thinking about cash flow, are you looking for cash flow immediately? Or, in a lot of these kind of like value add deals where you buy a deal, you need to renovate it in some way, and then it starts cash flowing.
So I was in 18, 19, 20, 21. I was looking for those value add, big payday, quick, a lot of them had 3, 4 year, 5 year, 3 to 5, and then they were exiting within 2, 3, and they were great. But now those are non-existent and very risky. So I don't do that anymore.
Yeah. Why do you think they're risky now?
Well, because, in a market where interest rates are low, you have the wind in your back and you can make a mistake and the market will help you, will support you. In this market, if you make a mistake in your underwriting or your exit point or your rent appreciation or your cost or your timeline, anything can kill you. Any one of those mistakes can kill you in a market where liquidity is shrinking and values are on the cusp of coming down. So I would, it's just too much risk.
Yeah.
And usually rule number 1 is don't die.
Yeah, don't lose money. So how has your strategy shifted then? So early on you were looking for tax breaks, then looking for cash flow, and now that the market's changed and interest rates are higher, how do you think about that?
Yeah. So I look for stuff like that deal, like the David Zook stuff. I'd also look for right now I'm looking into service businesses. And service businesses, anything from if you hired a plumber or you hired an HVAC company or a pesticide company today, it's hard to get good people to come on time, and you're going to pay whatever they tell you you're going to pay. So right now, all the cash flow is there in the service business providers. And so for the good operators that have good teams with good cultures, that have high level, strong recruiting and strong retention strategies, those guys are doing really well arbitraging the labor shortage that we're seeing. And so that's what I do right now. So I buy them. I invest in funds with good operators, but I also buy them directly myself. And hopefully I'm planning on building a fund myself as well.
Yeah. It sounds very similar to one of the other funds that you mentioned before on the call, like these managed service providers. Tell us what makes that interesting to you. Let's go down that rabbit hole.
Yeah. So managed service providers are essentially any third-party IT company that comes and helps your company build the network, or build their servers, or do security, or maintain your computers. So they're businesses that essentially hire technicians, and they rent you those technicians for a few hours, or you can have dedicated technology team for maybe $150 to $200 a computer per month. And so there's a recurring income component. And then, they sell equipment, so they make a percentage of the equipment, and then they sell software, and they make a recurring income on the referral of that software. So there are three models where they make money, but the bulk of their cost is just labor. And they're usually anywhere between 48 to 55% gross margin, and they can net, anywhere between 20 to 30% margin. So, and they're, right now they're being sold, the smaller size under $1 million EBITDA, they're sold in the 3 to 5 times multiple. Anything over 2 million, they go up to like 8 to 10 times multiple. So as soon as the revenue goes up and profitability goes up, the multiple goes up, and which allows for really nice exits, in addition to the cash flow component as well. So they cash flow really well. So a typical deal would have anywhere between 10 to 12% preferred return. It will return the money within 3 years, 100% of the money within 3 years. And then it will have anywhere between 30 to 35% IRR. And usually it'll swap, it'll start like 80% paying to the investors, and they'll swap after that 30 or 35%, and you stay on at 20% equity after that.
How do you find these deals?
It's a really high return.
Yeah, I'm interested now.
Yes. So that's the beauty of like business acquisition, is that it does provide higher returns for sure.
Yeah, that's super fascinating. Where do you go to find deals like that? Like, I haven't come across a deal like that, probably because that's not the space I'm playing in.
Yeah. So because I've done this before, I used to be the hired help, if you will, the contractor that comes and fixes this when a private equity buys a value add. So I used to be that person that goes in and adds the value. And so I have plenty of contacts in the space, but there are funds. There are plenty of funds. Just look up small middle market private equity funds, or middle market private equity funds. Those are the ones. And you just talk to enough of them. Again, I'm hoping to build one this year, but yes, there are plenty out there. You can. It's not very hard to find.
Yeah. I'd like to take a second and kind of go to one of your deals that has went sideways. Before the show, we talked a little bit about one of those deals, and would love to share that with the audience. Of just share one of the deals that you invested in, why it went sideways, and what you've learned, and maybe what you're gonna do differently moving forward.
Yeah, I'm going to go a little bit graphic here, but
I love it. More graphic, the better.
I just say, like, kids that get abused, usually abused by someone they know, and some family member or whatever. Usually investors get abused by someone who they know. And I think this is one of those things where I've known this person for a long time. I've trusted them. I've liked them. I've never worked with them, but I've been around this person. I've known this person for a period of 10 years. So which kind of like made me not, and we were in the market again, we were smack in the middle of like 2020, like the second half of 2020, 21, where you could do no wrong, if you will. So, it's the one time that I got screwed. It's like the one time that this happened to me. And it's the one time that I didn't pay attention, and I didn't do any due diligence, and I didn't really research much. I should have just called somebody that invested with this person before. I would have found out that they have not been. I wasn't like, I'm a skeptical person. You know what I mean? As an investor, I ask a lot of questions and I'm a skeptical person, but in this case, I wasn't.
So you got a little, you've gotten used to investing in deals, and then this one got away from you.
Yes. And I trusted the person because I thought I knew the guy, and it just turned out. And honestly, it's not like the person was a bad person. They were just incompetent to this at that scale.
So set the scene.
You know, so they were a bit.
Set the scene. Like, what was the asset? When did you invest? When did you start to notice things go sideways?
Yeah, so it's a single family flip fund. And it was I believe it was end of 2020, early 21. And the goal is to acquire, hundreds, thousands of houses, and then or fix them and buy and hold, and then put tenants in there, and then build a portfolio that we can sell to private equity. And that was the play. And so this person was doing okay at a small scale, maybe 50 to 100 houses. But what they did is that they raised enough money to go scale to that 1,000, 2,000, homes. But they didn't have the capabilities, the team, the leadership skills, the management, the financial chops to be able to run that big of an operation. And they sold it. They were really good. It was a good communicator, good salesperson. They sold it as they had this, Mission Impossible team that can get it done, but they didn't. And essentially, like a few months later, we started asking more questions. The people that were asking the questions did not have answers, or they will say they're going to come back to us and they don't. And the numbers, the pref returns weren't there. And we asked more questions, and then you start seeing turnover in the team. And then you find out that it's all, coming down, collapsing, and they're asking you for money. They're asking you for more money. And, and then the decision is you just put in more good money after bad, or you just walk away and you eat it. And I decided to just walk away. It's not worth my time. My mental health is valuable, and I don't want to put good money after bad money.
Yeah. So how do you think, we talk a lot on the show about operator first, and a lot of people say, I've known this guy for a really long time, and, he's someone who I trust, and I look at the operator first and the deal second. And so this is maybe a good example of how that's gone sideways. You mentioned that, it would have been good to maybe connect with other investors who've invested with them. Do you think that really would have uncovered this, or are there other things that you're now having on your mental checklist moving forward?
Well, it's a good question. I think you have to look at it so if whether you know somebody or you don't know them, you have to you give them the same level of scrutiny. And then you literally have to you don't want to go in with the warm and fuzzies. You want to go in with a cold-hearted, I'm going to get to the bottom of this kind of, scenario. What can I find so I don't invest in this person? And that's pretty much the idea. And if we can't find anything and the deal looks good, then that's when you invest. And to me, that's how I've always done it, except that one time when I went in deciding that I'm going to invest before I did my due diligence. So, and I just went through the numbers, and people can show you any numbers. They went through the team. They can show you anything. It doesn't matter. It's the experience. Yeah, I should have called enough people. I should have asked more questions. But I didn't, just because I kind of knew the guy.
Yeah,
so
happens.
Hit me once.
Yeah.
Yeah. Yeah.
Totally.
Yeah. I think there like, I think a lot of it is people understanding numbers for sure, understanding the deal, understanding the asset, understanding the structure, understanding the market, understanding the operator. All these things are all data points that add up at the end. So when we talk, we're not going through them, but these things are happening so quickly, so fast, and all at the same time that sometimes we don't break down that process in our mind, how we're going through. And if you go in with thinking that you're going to invest with somebody before you even do due diligence, you're going to skip all that and make a mistake.
Yeah, it happens to the best of us. What you've mentioned something where you talk about understanding the market. It's something I've heard often. What does that mean to you?
Yeah, so understanding the population growth, understanding income growth, understanding the drivers of that change, of that growth, or that, if the strategy is to go to a growing market, okay, how is it growing? How much growth? And then why? And is it growing just in population? Is it growing in income as well? And then what are the drivers behind this? Is there like new industries, or is it just and it's just in the environment or the economic environment that we're living in because of COVID or because of something else. So I think it's just going, peeling the layers essentially of the story behind the market. If someone comes in and says, "Oh, this is a stable market," great. What does that mean? What is a stable market? What are the drivers of that stability? Is there a certain type of employers? Are there certain types of industries, certain type of so lifestyle. So I just want to understand, how this market has done in the past. How is it going to try to predict? How is it going to do in the future based on, different data points?
Yeah, something a mentor of mine has told me, for example, is like looking at Detroit. So if you're investing in Detroit, and the automakers are the only real employers there. Well, in times of bad economic crisis, like in 2008, when a lot of the revenue of those companies went down and they laid off a ton of employees, they were really the only employer of that market. So if you owned real estate during that time in those markets, you would have been crushed.
Absolutely. Yeah. And a lot of times you think, they say, there's the banking industry and then there's the medical system. Well, maybe if the banking industry goes away, that medical system is not going to be there. Or you don't think they're correlated, but they are. And, if you have a big drop in population, a big drop of incomes, a lot of other things are going to affect it that may not look correlated. They're going to be correlated. So I just want to understand the dynamic. Demographic is destiny, especially for deals.
Yeah. Jay, this was awesome. Thank you so much for joining us on the show. I loved having you on, and looking forward to seeing you soon.
Thank you for having me.